Okay, good morning, everyone, and you're welcome to our final Coffee Microcaps morning meeting for 2024. And hopefully, we're going to go out with a bang here this morning with our three companies presenting this morning. I'm just going to quickly run through a couple of intro slides, and then we're going to get straight into it with our first presenter. For anybody who is joining us for the first time, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and for our regular attendees, you're very welcome back to our event this morning, and thanks for joining us once again. I would like to just mention RAS Research as a Service, who are our sponsors for all our online events here, Coffee Microcaps. If you do indeed are looking for some research on some small microcap names that are not covered by the sell side brokers, please do check out the Rask website. There's lots of free research to download there. A quick compliance and disclaimer slide, and a warm welcome to our friends from ASIC this morning. For anybody who is joining us here for the first time, our definition of microcap under 300 million in market cap. We tend to have companies on here in revenue, approaching cash flow break even, or as will be seen this morning, are indeed already profitable. We tend not to have companies from the resources and biotech sectors on here. So everything else, what I like to call industrial microcaps, which encompasses financial services, healthcare, hardcore industrial businesses, professional services businesses, technology businesses, anything kind of outside of resources and biotech. Structured this morning's webinar. We have three companies presenting this morning. As I said, each company will have a 30-minute slot. We'll break that down into a 20-minute preso, 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate as we're going along. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us pretty much on all the socials. Twitter's our main one, YouTube for the recording of this, and indeed we've 100 plus webinars up there now, so a long list of microcap companies if you're interested in more content. LinkedIn, and I do write a free monthly newsletter that you can get on the Substack platform. First up this morning, I'm delighted to be welcoming for the first time actually the Coffee Microcaps, Stephen Kowal, CEO of Atturra. Then we're going to welcome back Geoff Jamieson from Orcoda. And then finally, we're going to round out welcoming back Chris McFadden from AF Legal Group. But that is enough from me. I'm going to stop sharing my screen. And Stephen, if you want to start sharing yours, I'll let you know once I can see it coming through. Yep, I can see the cover slide of your presentation now, Stephen. You can take it away.
Fantastic. Look, thank you, Mark. Thank you for everyone joining us today. As Mark mentioned, Stephen Kowal, CEO of Atturra. Look, today I want to give you a bit of a brief overview of Atturra, who we are, what we do, where we're going, and what we want to be. Like all good presentations, a disclaimer. I expect everyone to read it and do a Q&A at the end on that. But seriously, let's talk Atturra. So what are we? Look, we're an IT advisory and solutions business. So what does that mean? That means that we help provide government organisations and private organisations modernise their environments. We do those technology services and solutions. We have teams that build out solutions, and more importantly, and something that we've really moved into over the last sort of 2 years, is we then go and do the ongoing management and support of those services. And the reason we call ourselves a solution company is, in addition to that, we do build IP. We do build that IP tends to be around our industry approach. We have about 1,000 staff now, spread predominantly across Australia, though we do have small satellite offices in Hong Kong and Singapore. So a bit of company profile. We listed on 22nd December 2021. We're at 50 cents. We're $1.07 yesterday. We're about 240 million of revenue, 25 million underlying EBITDA. As I mentioned, about 1,000 or so employees. Founded in 2015. I kind of broke Mark's rules. We're over 300 million, but to be fair to Mark, he's been chasing me since we're below 300 million. It just took us a while to get. On the side of this presentation, you can also see we have quite a diversified revenue base. everything from defence, all the way round through all our kind of focus industries. And that's kind of important from a risk management point of view, having that diversified revenue. So let's talk vision and strategy. So we want to be Australia's leading advisory and IT solutions provider. And why do I say that? It sounds like a bit of a weird comment. Australia's a little bit unusual in the market in terms of lots of countries have, a kind of a marquee end-to-end service provider, be it Datacom in New Zealand or Accenture in the US, Capgemini in France. We don't really see Australia having anyone that fits in that kind of location and space in the market, and that's kind of where we see our opportunity. So we've got a kind of a passionate staff base about building a quality service provider business here, having not only the application side, but also having that infrastructure side, and then importantly, develop IP in our industries. So how do we do this? We go to market via industry. That is a little unusual. So what we do is we make sure we employ people with deep industry capabilities. And when I say industry, what I mean is, if you look at our K-12 business, it's run by someone out of the education business, an ex-teacher, also worked in state government. So they talk the language of our clients. And we find that is a really big sales differentiation. And then the other thing is that lets us build out industry-specific IP. The reality is the solutions you deliver to a school are very different to what you deliver to a utility. So we build out not only our offerings, we obviously put wrappers around them in the industry, but then we actually go build specific IP as well. And that just kind of gives us that lower client churn. We are a tech company, of course. So having a tech company, we have a tech strategy. And it's kind of evolved a little bit over time. So the first 4 points here have not changed for many years, but the last 2 points have. So we pick high growth technologies. We tend to buy or acquire small companies that specialize in those technologies and then invest in them and get kind of above market growth. A good example of that is Boomi. We start off with a small team of Boomi experts. We've now got 270 plus data integration staff. So that business grows really rapidly. The iPaaS market also is growing at about 40% per annum. So it's a really good market to be in. And then the other thing we like to do is pick really niche and specialized technology services. So I use QAD as an example. It's a specialist manufacturing ERP system. We acquired a small company a few years ago. They had about 40 clients roughly in manufacturing. We've expanded up to 70 also clients. And it's really predictable, gives you a bit of pricing power. But probably more important than pricing power to me, to be honest, is the stability. When you're really specialized and when you've got niche solutions and products, you tend to find they're really predictable business from them. And the next point I've got in this slide is actually new for us. We've grown a fair bit, roughly 30% per annum since 2019. And so what's happened is as we've grown, we've started to do work with bigger and bigger clients. And one of the gaps in our portfolio is that enterprise software sort of product gap. So things like ServiceNow and SAP. So what we're going to do over the next few years is we're going to actively look to try to either acquire or organically grow a ServiceNow and SAP type business. And that's just all about increasing our addressable market. All that sits on our end-to-end managed services business. So we really got into managed services, only sort of 24 months ago, and then did a rather large acquisition at the end of last year, which has really built that up. And then recently, for those who might follow us, we actually just bought a managed service provider in New Zealand just a few days ago, maybe a week or so ago. And it's very heavily in the networking cloud, but we're adding that into our portfolio. So we pretty much now have a private network that spreads from Perth to Brisbane, Wellington and Auckland. We've got operations out of 5 data centers. And so we can pretty much service any client in ANZ now with the full stack of services. We can look after their infrastructure, we can look after their cloud environment, and we can do their apps development and transformation. I'll quickly touch on our industry experience. So as I mentioned, we go to market by industry. And here you can say I'm going to clump some of these together in the interest of time. So, if you look at federal and defence, we have over 300 security cleared staff. That's a really important differentiator because it doesn't make any difference who you are or how good you are. If you haven't got security clearances, there's just many areas you can't work in. So we have a very strong security cleared team. We have the ability to sponsor security clearances as well. So we can continually grow our security cleared team to do those projects that need those clearances. So that's a really good, predictable business. It would be fair to say it's been pretty erratic in Canberra the last few years with the cut down on consulting, but that's only a small part of our business. The majority of our business are in those bigger project and applications. In addition to that, we also run a member organisation which has about 450 SMEs. So those SMEs, we help get business and defence. And what's really valuable for us in that industry engagement is it gives us unparalleled insights to the capabilities. So as we grow, we can start positioning ourselves now as a proper service integrator and bring together consortium type bids to do larger transformational projects. And we've been building that SME industry engagement now for over 10 years. So we've just got unbelievable depth. The next two industries I'll also clump together. And that's because historically a lot of our work in those industries has been a result of our data integration team. They're things that every time regulation change comes, we're Australia's largest data integration team onshore. We work heavily with utilities, with the wealth managers and financial services. And so we've got like a continuous flow of business in there. What we have done in the last 2 years is we have started to bring in our Microsoft capability, both into utilities and financial services, predominantly utilities. And we've managed to get really good footprint and now have several major Microsoft clients in the utility space. And to be quite transparent, what allowed us to do that was that strong industry focus. And we weren't just going in trying to be another IT organization. We were going in there as industry experts that could enable the technology to drive the business change. Manufacturing, I touched on before. We've got an absolute very strong position here in the marketing QAD. We basically have the majority of their clients. We've doubled that business roughly since we acquired it a few years ago. And we've got in process now an actual acquisition, which will increase our manufacturing base again. So I think we're already the largest provider of IT services to manufacturing and specialised, and now we're going to double that. So, we should have well over 100 manufacturing clients at the end of an acquisition we're currently in flight. Going back to our 2019 days, what we're probably famous for are the next two predominantly. One is local government. So we're the largest independent technology one service provider, but we also do Infor and a heap of other things, Chris 21. So that are all the solutions that local government use. We have those business processes, we have those business capabilities, as well as the technology capabilities. And people really underestimate the sheer complexity of local government. If you think about local government, they've got to service all these constituents across all different age, across all different professional categories. They've got to look after roads, they've got to schedule stuff. It's a really complicated business. And the fact we've got hundreds of people who specialise that really gives us a strong footprint. And as a matter of fact, we only have one salesperson in our whole local government business. And that salesperson's job is actually to bring our other offerings into local government, not really to sell the core local government offering, because we're just that well known there that predominantly that's an inbound piece of work. K-12 really helped a few years ago by an acquisition, but we've materially expanded that, and it's I'd say we're getting into that position now. We're almost becoming famous for the service provision we do in the K-12 space. So, it started with the classic sort of infrastructure and then notebook programs, but now we're using our AI capability and our applications capability to build stuff out. And we're actually building a student management system where we just had a major go live actually just a week ago in Brisbane, which is going really, really well. And then our newest industry, resources. This is accumulation of an acquisition we did last year, where we bought Cirrus Networks that had a good infrastructure footprint in resources. We have a very strong document management capability and resources. So we've kind of combined that together, and we had a large win with a global resource provider, natural resources company. And so we've started to build out specific IP and solutions around natural resources. And it's a really good area because, they are good long-term clients. You can build out specific solutions to them. And there are not too many organizations out there that really focus on being experts in resources versus being those generic companies. I put down the bottom of this slide kind of the core into then I think I cover them all off, and then our managed services business. It's out there in the public domain, so you can look at it. But we are building and investing in building products as well. So we've got that classic service and solutions kind of company, but we're building out products. So we've got a school information system that we're jointly building with Brisbane Grammar with support of Microsoft. We've got a really solid pipeline for that. We just had some really key go lives, really, really happy client. That's, to me, that's probably a sort of a 3 to 5 to 10 year play. Atturra Cloud Platform is actually the branding over a whole heaps of solutions we have. Probably the most important of those is our Boomi solution, where we're hosting Boomi for their clients, and they actually can sell our solution in. So they've got 20,000 plus clients across the world. Now you can go to the Boomi price book, you can buy our service and get delivered through there. So look, I think that's got huge potential. Time will tell. The sales cycle is kind of 3 to 5 months per deal. So I'm really hoping by sort of early next calendar year, we'll have a really good insight to, is this really going to take off or not? I'm very confident it will. And then we do some other specific solutions. Day Online, this is where we connect local government and state government using our data integration capability. It's actually a fantastic solution, and we think that with some of the pressure on housing development and speeding stuff up, that there's actually a lot bigger and broader play for DA Online for us to take forward. But the reality is we connect a local government to a state government to make that process seamless. And for example, when the state government changes its data requirements for our clients, they leave work on Friday, come back on Monday, and it just works. If you're not one of our clients, you've got to go change your systems and do all that, and you can be out for quite a substantial period of time. So what's all this mean? Obviously, on the call here, and investors as well. Look, we've had solid revenue growth, more than 30% year on year since 2019. About half of that growth has been acquired growth. So if you kind of dig down the numbers, it's probably roughly 16% acquired growth and 16% organic growth. So we do kind of see a half and half mix, and the underlying profits obviously grown along with that as well. And we do target a 10.5% underlying EBITDA. And then our revenue composition, I won't dive into this too long term, but we've been focusing on improving our recurring revenue, and we've got a really tough definition of recurring revenue. We've got it out there in the half-year, full-year results packs. But we've got, roughly 30% of our business is locked in recurring, but then we have another 30% of our business, which are where clients have basically bought the same sort of services from us for 3 or more years. So, we have a lot of stuff. We don't kind of call it recurring because it's not in a long-term contract. But the reality is they've bought those services every month, every year for 36 months, or for 3 years, I should say. So we count that as kind of predictable long-term client revenue. And then the rest is ad hoc. So that is obviously clients of less than 3 years, things like product purchases, ad hoc projects and programs, and those sort of activities. For those who follow us, you'll be well aware of this. For those who don't, look, we did a capital raise just recently to do 3 acquisitions. And of those 3 acquisitions, actually closed 2 of them already. And another one is in that completion period that hopefully will close in the next month or so. And so that's going to bring a fair bit of incremental value into the organisation. And you can see the numbers here on the slides in terms of this. But more important to that, it actually brings some really important incremental capability to the organization. So the three acquisitions I'll cover off really briefly are one I touched on before, which is that classic managed services. So network and cloud. So we've got quite a strong private cloud business. We don't break that out to market, but I think we probably will sometime in the near future to kind of boost that operation. It now gives us kind of seamless connectivity as well across all of Australia and New Zealand. The next acquisition was enhancing our ECM business. So we already are a market leader in OpenText ECM, but where we didn't have capability was in the SAP component of that, the XECM component. So we bought an organization called Chrome, which we knew really well, really good cultural fit, and they bring that other half of the house of the OpenText solutions to us. So that's fantastic. We've got really a strong end-to-end capability there. And then the third one, which is in flight now, is really another niche or specialist product, but brings in additional manufacturing and supply chain capabilities. We're big believers in, that over time, you're going to see a real rotation, domestic manufacturing, things like supply chain security are becoming more and more important. So we've invested in that area. We're making a long-term bet on that domestic manufacturing capability. So why Atturra? This is my last slide, and we can go into Q&A. I think I've actually kept the time, which is a miracle for me, by the way. So why Atturra? So we are a sovereign IT house. That's really important with geopolitical issues, really important for SOCI companies, very important for government. We'd have a blend of organic and inorganic growth, and we're going to continue down that path for the next few years. We have that deep industry knowledge. We do actually have that full end-to-end capability. As a matter of fact, those products we've built out are only really possible because of our full end-to-end capability. I didn't really touch on the AI today. That's almost an entire session on itself. But we do have a very strong data science group, and we've taken out some industry awards this year as we kind of, I think it's on the lips of every CIO and most CEOs. And we've got the advisory capability up front as well as the technical capability to implement that. And then obviously we've got a very strong balance sheet and revenue base. Thank you. Happy for any questions.
Thanks, Stephen. And we have been chasing you for a while. So you were microcap, I think, when we started the over and back in the share price has kind of run a bit this year, and you've tickled over. But nonetheless, a question for me: the 1,000 staff that you have, are they all full-time perm employees, and or do you just upweight, downweight with contractors as need be? And if they are full time, I mean, just how do you manage that bench that you've got kind of people employed as best you can, given a lot of these government projects, they say they're starting in March and actually doesn't kick off until July because of some budget issue here, there, or anywhere.
Yeah, so it's a really good point. I mean, it's always one of the kind of the challenges our business is balancing out those staff, especially, and you're right, it tends to be public sector that will have the delay or the short cancellation and can definitely cause some volatility. In that 1,000 people, we do have some people like 3 days a week, as a bit of job share, but we would have actually more than 1,000 FTEs as well. So the number's above 1,000. But we do have a strong contractor base. So what we try to do, and it's definitely not a perfect science, we try to keep a contractor employee ratio and then make sure that the volatility is more in that contractor space. Contractors are used to coming in, they get paid more, but they've got more volatility. So we'll try to have, for example, depending on what technology stack, we may have 80% employees, 20% contractors. In some areas, we have 95% employees because it's super predictable. And in some areas, we have like 70% employees. And it's all based on that volatility of the skill set.
Okay. And I mean, you talked through, over the years, various acquisitions, and, you've recently done the cap raise to do to 3 more. Is that something we should expect, moving forward, over the next year, 2, 3, that, continuous little bolt-on acquisitions where it gives you, niche IP or, an into, a different level of federal government or a different part of state government. Is that something we should continue to see?
Yeah, you definitely will, at least for the next year and probably for longer. Is yeah, we are continuously looking out for either those niche or entry points in the market. So, we've got quite a strong balance sheet, um, going forward. So yeah, we'll keep acquiring, and we kind of like to think, over the mid to long term that half our growth is organic and half is inorganic. Not a perfect science, obviously. We've just done a few acquisitions, so next year you're going to get a bit of a skewing to inorganic. But historically, it's been through sheer luck, not planning. It's been about 16% organic and 16% inorganic. But I think that's better luck than good.
Mhm. And with those acquisitions, should we also expect the client mix to kind of further diversify? Should we see, healthcare in there as a vertical or telecoms in there, or maybe a new geography? I don't know. There's a kind of an expansion of the you said you have a few satellite offices in Singapore and Hong Kong, but should we see a greater contribution coming from a Southeast Asia part of the business?
Yeah, so it's interesting we use those more as sales offices. We actually deliver most of our stuff from Australia. So even though we bring revenue in through those sales offices, it's actually predominantly delivered from Australia. We're still very Australian, New Zealand focused, but you will definitely see us, change the revenue mix a little bit if we go acquire an SAP company or get some sort of niche capability. But I think in the medium term anyway, you'll still see a strong focus to Australia, New Zealand.
And, across those client groups, whether we're looking at federal government or we're looking at resources or back to local government, is the margins pretty much the same across them all, or is one of them, noticeably, better business for you to do? I'm not thinking, the stability of the revenue foresight, just more the pure margin of actually working with a particular set of clients.
Look, it probably more driven by the tech stack that we're doing. So, for example, certain projects are higher margin than, for example, maybe our network services, which is a lower margin but more predictable. So it's probably more driven by the tech stack more than the industry.
Okay, so yeah, and that can vary depending on what's happening with particular client numbers. I just want to touch on the federal government, as you said, it's been a bit up and down in Canberra, but we had the guys from High Tech on here last week who, were saying, a year ago there was, a huge pullback on the use of contractors within federal government, but now they're saying, over the last kind of 12 months, that's nearly completely reversed. And actually, they probably got more contractors working in Canberra than they had like 12 months ago. Is Would you say you've seen a kind of similar turnaround where, it was,
No, no,
massive budget
definitely not.
cuts 12 months ago, and now it's kind of they've realized actually you can't cut the budgets on these projects if they want to deliver what's needed, especially they were saying, within defense, there's just you cannot deliver the cybersecurity goals that government want to deliver and need to deliver in the new geopolitical environment without spending money, and the skills have to come from somewhere, and it's guys like you, it's guys like High Tech, and it's just the nature of the beast of where we are.
Yes, I mean, from our point of view, obviously that we saw the big downturn, predominantly in staff org and consulting. We don't really play in staff org, so that didn't affect us much. Definitely consulting. We've seen, and as a matter of fact, even in the AFR, I think it was yesterday or the day before, they've actually continued to cut. I think it's gone from like 1.6 billion down to about 400 million. So they've not increased that, and I think hopefully we're at kind of the plateau. We are seeing more projects in Canberra. So they're kind of those bigger, chunkier activities, and things like defence have been very clear on their kind of industry priorities. But in that pure consulting and ad hoc stuff, no, we've seen it continue to be pretty poor, to be honest.
Okay. And a few of our attendees on here this morning might remember, and you probably remember, business called Empire out of Perth that got taken out by Capgemini. For people who would have known the Empire business, would you say it's a pretty much akin business to where Atturra is? Give or take. They were kind of very focused on resources, did a lot of stuff in state government work, especially in WA and their home base. Can we
Yeah,
kind of
that is
say Atturra and Empire are kind of similar businesses, and people are trying to kind of think of it in a business that might have known and followed previously.
look, I'd say so Empire, good WA business, big Microsoft house managed services. We're probably the difference if you looked at the Empire business and us is we definitely have a lot more deep specializations. So that's probably as Empire's that classic IT services business, and very Microsoft focused. So is we've definitely got that Microsoft and managed services component, and that would be very comparable to Empire. But then on top of that, we've got these super deep solutions, that focus on being like Australia's leading local government service provider or leading K to 12. So it's that industry view which probably makes us a bit different to the Empire of old.
Okay, perfect. Stephen, thanks very much for joining us this morning. I'm glad we finally got it together. We managed to get you on, and yeah, hopefully maybe we can maybe see you again some stage in 2025. And best of luck with the last closure of the acquisitions. And I'm sure you're going to have a fun time integrating them all now and start of the new year.
Absolutely. Thank you. See ya.
Thank you. And we will cross now to our second presenter and staying on the technology team. I'm delighted to be welcoming back Geoff Jamieson. Geoff, good morning. How are you? And you just take yourself off mute there.
Can you see my screen?
I can, but it's a bit small. I don't know if you want to
Just hang on.
put it into
I'll get
presenter
it into
mode.
slideshow. There we go.
Yeah,
Is that
slideshow
better?
edit. Yeah, that's perfect. Now, Geoff, you can take it away whenever you're ready.
All right. Thanks very much, and welcome everybody. First of all, we've got a disclaimer on this, so I won't go through that. But just a snapshot of Orcoda. Orcoda came from the name Organized Connected Data, and that's what we do. We connect data from the plethora of databases out there in our marketplaces and connect them together into a platform where our customers can make proper management decisions, particularly across their fleets. Our mission is to optimize and enhance the compliance of our customers' transport operations and supporting digital transformation. Digital transformation is on the lips of most CEOs and CFOs now, whereas prior to the pandemic, that was not the case. So the market's become a lot easier and in our favour. What we do, we integrate and optimize SaaS platforms and our in-vehicle management solutions and contracting services within our main platform. So all of these SaaS products hang off our main platform. Now, vision is to be a leading provider of intelligent transport management systems and seamless AI-driven smart city transport solutions. So that's it. We've got a 5 to 10 year strategy, and we see the whole marketplace in transport going into smart cities. Currently, we have 280 active customers, 700 vehicles, 7,000 vehicles using our technologies, 3.1 million movements we do annually, and we've got ARR at the moment of 6.4 million. Today, we're an integrated B2B provider of smart city transport technology and smart infrastructure solutions within transport corridors. And tomorrow, we want to be the provider of seamless AI-driven smart city transport solutions. That'll include digital twins and all of the things that are going to drive transport solutions of the future. So we've got today where we make money out of the things that we market, and tomorrow fitting into a lot bigger marketplace that is huge. Our journey to date is towards our strategic vision. In 2012, we founded Resource Connect and we patented a booking system. That booking system was built to book people, parcels, and goods onto the transport assets that they travel in, that being bus, plane, car, truck, whatever way someone was getting to work or a parcel was being delivered or whatever. And that's all done through our booking system. We then moved to the next step, which was to look for a transport management system with a true optimizer. I went to 62 different platforms looking for true optimization, and I couldn't find it, but I finally found it in a company in Melbourne called SmartTrans, and we merged Resource Connect with that, rewrote their program to a cloud-based program, integrated it with our booking system, and that became the first part of our intelligent transport management system. We then went to Transport Main Roads and said, look, we want to start connecting into devices as well as manage transport operations. And they said, look, the only way that you'll do that is if you build the infrastructure and install the devices and connect. Hence, we purchased Better Group, which they already had smart city capabilities, and we're delivering those sorts of products. And that was the start of our smart cities transport installations on road, rail, and air networks. And then the missing link was telematics, although we joined in with a number of telematic companies like Teletrack Navman and GPSI and eRoads. We wanted to get involved in the whole marketplace, and therefore we acquired Future Fleet, which had all the in-vehicle fleet management solutions, both software and hardware, and we're basically agnostic towards whatever telematic company they dealt with, but mainly it got us into Mix and Power Fleet, and we're since getting into Geotab. So all of those together make our intelligent transport management system. So what's this intelligent transport management system look like and do? Our transport booking system books people, parcels, and goods onto the assets that they travel in. It processes all the bookings. It does all the customer management. So it's really like a CRM, but specifically built for transport. And it does all the payments. People can get on there and make all their payments for their trips and things like that. And that's proprietary software to Orcoda. And again, we're organising the connected data within that against the transport management system. The transport management system does all the planning, decision-making, and AI-driven optimization for the allocation of jobs, drivers, to making sure all the drivers in the right vehicles, the right vehicles are there for the right booking, and so on and so forth. And then it does the execution of the planned schedules and routes for the pickups and delivery of people, parcels, and goods. And then it does all the measurement and reporting. Our telematics is all about the vehicle. That does all the in-vehicle management systems, maintenance, everything to do with the vehicle itself. It does all the driver behaviour with AI cameras. It tracks the vehicles, so we know where all the vehicles are all the time. It does fuel management and all of those sorts of things. And then we have our transport infrastructure system that installs IoT devices in transport corridors, installation of smart lighting, smart cameras, and connecting networks. So connectivity is one of the most important parts of this whole thing. If you haven't got a connected network, you can't connect all the databases, and obviously our APIs then connect and organize all that data. So within this whole transport management system, you can make very, very good decisions. And the future is AI-driven digital twins and the management of big data. So big data is going to be the major management tool of the future. Just a quick run through of a couple of case studies. Our transport telematics, transport booking and transport management system integrated. So this is in our community transport, which is one of our growing areas at the moment. So a person can get on. Most of the this sort of transport's run by the very large not-for-profits. There's some 500 of them out there with some 30 or 40,000 vehicles, and their customers or clients, as they call them, who are all connected in NDIS and My Aged Care, can get onto our app, book their trip, pay for their trip if they have to pay for it, or if they've got an allocation from government, it allocates that. It then goes, all of that's plugged into our transport management system, which has got all the fleet in it. Obviously you can, with My Aged Care or transporting people who are aged or with disabilities, lots and lots of constraints, and therefore the optimization of matching all those bookings with all the right vehicles for the right trips to utilize the vehicle so you can get more people in one vehicle, be that a bus or a car, and it optimizes that whole schedule and route and then sends that out to the driver. The driver then uses our app to look at his trips for the day. Within that system, we've been able to, one of our clients is doing about 12 trips per vehicle per day. They're now doing 24 trips per vehicle per day. So a huge increase in efficiency and utilisation of fleet. And the driver, before he logs on, or before he can start his route, he's got to do all the governance processes, no alcohol, no drugs, vehicle all ready to travel. And once he's got all those ticks in the governance process, he can then start his route, and off he goes, picking up people, parcels and goods, mainly here people, and delivering them to where they need to go and picking them back up and taking them home again. We've been lucky enough in that to be picked for the ACTA trial. ACTA is Australian Community Transport Association, and that trial started in July, fully funded by the federal government. We're one of two in there at the moment. There was 4 selected. We're probably the only ones that are delivering proper DEX reports at present. And once that trial is finished, which finishes in June, we will get appointed, we hope, and fully funded across all of the transport providers. So huge future there for community transport. Another good example is where telematics are used, because each of those vehicles in the community transport have got the telematics in, and it's same here, the buses, the utes, cars, trucks, anyway anybody's getting to work, and this is for remote work sites. The worker can book the transport in accordance with his roster. The roster, you can imagine out there on a project or a major mine or a major oil and gas project, there's probably 100 subcontractors out there with 100 different rosters, all have to marry in with the project or the operational roster. And our system manages that whole process and organises all the workers to go onto the right transport, that be a bus, a car, truck, whatever it is, however they're getting to work. But before it does any of that, it books the accommodation. Our systems are connected into the accommodation providers, books the accommodation, because there's a large expense transporting people from all around the country to wherever the work sites are. And then it buses people from the camp to the work sites each day. And then it also makes sure that they're fully compliant, and they can't get onto a pre-start or a toolbox meeting unless they're fully compliant, and they can't really get on any transport unless they're fully compliant. And then they scan on with the app onto each of those transports, be plane, bus, car, truck, whatever it is. And then at the end of their cycle, which may be 2 weeks, 3 weeks, 4 weeks on off, they start that whole process again. So they just go round and round in our system, and we obviously make money out of that on a per person basis. The telematics, so the telematics in the vehicles, a lot of people don't realise what goes on, all the devices that are out there with telematics, and there's all sorts of, there's a plethora of databases, plethora of devices, and multiple software programs that we need to connect to make sure that we're getting all the information back into the main platform. And that's critical. So most of the telematic providers sell their telematics and their software solutions for in-vehicle management. They also sell our system because we do the people part booking, and we also do the transport management of the people, parcels, and goods to wherever they need to go. And there's a very good mix there because we both sell each other's products, which is great. The transport infrastructure system, which is made up of IoT devices, smart cameras, smart lighting, traffic sensors, wireless mesh networks. We are installing some of these now. It's early days. We're starting to connect these things, but this is the future. And a lot of people think the future is around the technology in vehicles. We do not believe that's the case. The whole system will operate on the infrastructure that is going to be installed into all these smart road, rail, and air networks, and they all require electrification, connectivity, data management, digital twins, and artificial intelligence. And they'll be made up of wireless mesh networks, wireless smart light networks, smart pole networks that have everything hanging off them, all of your stop lights, all your IoT devices, your cameras that manage everything will all be there, and we will connect into all of those to make sure that we've got a totally integrated system where it all comes into one platform so you can make proper management decisions. And that's across road, rail. And when we say air, we're talking about drones. Drones are going to be the future as well. So, and digital networks and digital twins will be built around every person will have a digital twin, every vehicle have a digital twin, every road, every rail, everything will have digital twins built around it, and all integrate into one big platform at the end of the day. This is all the future I'm talking about now. So we're well positioned, and we are winning a lot of clients because people can see the whole picture of where the future lies. The apps that hang off our system which is where we make all of our money. So if you have a look at the whole platform, we've allowed lots of external apps to integrate as well. So it doesn't mean to say we have to develop the app. We've got other parties developing apps that plug into our platform, and they sell their app, and we make money out of their application as it comes in within our platform, which is good news for us. But we've got our community transport apps, we've got our metro delivery apps, we've got our workforce transport apps, we've got our turbine navigation apps. Those first three are really take a lot. They're not true SaaS. They take a lot of integration into the enterprise solutions of our customers. Therefore, the implementation process on those first three take a fair bit of implementation to get going. But the rest of these, the other four that we've got and other apps that are coming onto the system are all SaaS. So our turn-by-turn navigation, people can download that. What's beautiful about that is it's been taken up by councils that do rubbish collection and school bus operators and things like that, where I'll just give you a quick example. Rubbish collection on a normal mapping system, it goes point to point. The driver gets his schedule and his routes for the day, off he goes. There's a roadblock, a detour. It misses those 1,000 bins in that street. because it takes them straight to the next spot and it doesn't go back to pick up the bins in that street. Next thing, the council have got their phones running hot because people didn't get their bins picked up. What our system does is we're unique. We believe we're the only ones that have been able to achieve it. That does turn by turn. So it takes the driver within, and we've had to lock the mapping system back into the app, and that makes sure that turn by turn navigation occurs. And that's pure SaaS. It can be downloaded. Our carpooling's the same. Again, most local government authorities or major fleet managers that or government departments that pool their cars for people, their staff can book, and the app, they download the app, they can book the car. It's all done automatically. They can find the car. They can do keyless entry and keyless start if they want. Some want that, some don't, but they can just download it. It's an app, and it's great. And our fast miles the same. It's a simple system for where people can quickly do schedules and routing without all the optimization, and that's just being launched at the moment. The carpooling and the turn by turn is now building revenue, and fast mile is going out into the marketplace in January. And Seat Check is again another unique product that is being marketed by Future Fleet for buses that need to be under the chain of responsibility that came in July last year. They need to make sure every person has got their seatbelt on. And our system, what it does, and we've done it with Bluetooth, every manufacturer at the moment has to hardwire all the seats into a central device at the front of the bus where the driver can see it. The problem with that is it's not connected into any platform, so there's no checking, there's no governance processes that can be built in it. It's really up to the driver. With that, what we've done is cut out that 16 hours of work installing all the manufacturing, installing the wiring. We've done it with Bluetooth. Everyone said we couldn't achieve it. We have, and that will go out starting in January to most of the large manufacturers, the bus manufacturers, and all of the mining companies are requesting it now. So really good future revenue source, and it's 100% easy to deliver and a SaaS product again. Not a lot of work for us, and we can take those worldwide without increasing our support and development team dramatically. So that just requires us now to put on salespeople to go out and market those products. We've had very good profitable growth to date. Our CAGR has been 42% from FY21 to FY24. Our CAGR on EBITDA is 28% from FY21 to FY24. So good growth. We've got two divisions, and both of those divisions have been growing dramatically. The Transport Technology division, our ARR has gone from 2.4 to 6.4, and our total revenue 8.4. We have a fair bit of consulting in there on those bigger products that I told you about. And then we've got infrastructure services, which is where our resource product fits. So that's got software and hardware and large contracts to install all of the electrification and things like that. So and you can see there we've got a client list to die for. It really, Australia's top class companies are using it, and governments are using our technology platforms and our systems and processes. Our strategy, progress and outlook. We're growing a pipeline across our solutions, so that pipeline is growing at a rate of knots, and our SaaS platforms are really starting to grow, and we're looking at growing that ARR dramatically over the next couple of years. And we're testing new technology solutions, like I said, the Seat Check and last mile, fast mile as we call it now, and we're now really starting to put some investment into sales and marketing, which we haven't done before. So we're really starting to go into that worldwide marketplace. Infrastructure services, which is very critical to our smart city future. We've become a panel member of preferred contractor for Energy Queensland, which is Ergon, Energex and Eureka. They've all got smart city programs. That took a couple of years to get onto that panel. We're a panel member and preferred contractor with Transport and Main Roads for smart cities, and we're bidding to become a panel member of their and preferred contractor for Transport and Main Roads Digital. So we should know in the near future whether we get on that. And that will really start to bring our Smart Cities program together. Our value proposition, we've got customizable solutions, vertically integrated, scalable model. We've got a good exposure to the smart city marketplace. We got digital transformation is very beneficial because as I explained, it's on everyone's lips at the moment. We've got growing recurring revenue base. We're reducing the carbon footprint for everybody, which is great. And we've got a history of profitable growth. Just quickly on the marketplace, it's huge. The world is our oyster. Just the Australian and New Zealand market size today, right today, at transport telematics, which we can sell separately or together in the system, is a 5 billion marketplace with CAGR 11%. Our transport booking system, which we can sell alone as well or integrated, $10 billion marketplace, CAGR 12%. Our transport management system, again, we can sell that separately or together as an integrated solution, 12 billion marketplace, CAGR 7%. And our transport infrastructure, 5 billion marketplace, CAGR 10%. Overall, a $32 billion marketplace growing at an average of 10% CAGR per annum. We've got a very, very strong management team. Myself, I've had 40 years experience as MD or CFO of technology companies and growing them I grew one into the largest IT company in Australia and sold that out to Wang and Unix. Same with another company, sold that out. And we're basically growing this for our shareholders. This one, Samuel Yu is 20 years in investment banking, MD of Barclays, VP of Carlsberg and Goldman Sachs. So good background. Jesse, fantastic background in technology and managing cloud-based solutions architecture. Simon has come out, he's our GM of Transport Technology, and he's come out of major projects right across in the UK and in Australia. So really knows a lot about major projects. Rick Polsey heads up our Future Fleet, 20 years with Future Fleet, and is growing that very, very well at the moment. When we took it over, it was doing 2.8. We'll do 4.4 this year under Rick's direction. And Ray Jeffries heads up our Better Group, and he's ex-Ventia, grew that in the region where we are from 7 million to 31 million. We've grown Better from 8 million to 16 million, and he's doing a great job. So I see him taking that to the 30 million mark as well. So in conclusion, as cities and major regions around the world initiate AI digital twins for transport, we're well placed to be a leading provider of seamless AI-driven smart city transport solutions. But the beautiful part about it, each of these products, and as we build these bricks on the way through, each of them we make sure they're profitable, so we don't launch anything unless we can make a profit out of it each step of the way. So that's it in conclusion. Questions, please.
Thanks, Geoff. Just on the 280 customers, and you talked about the various markets that you're targeting. I mean, whether it's aged care or resources, the kind of two examples you gave there. I mean, are you the largest provider, but still only maybe 4 or 5% of the whole market? I'm just trying to get a sense of, where you sit in those a couple of different verticals in terms of, market dominance or share of that particular industry.
Yeah, so let me first say, I think, yeah, our two USPs are one, our optimization platform. There is no other in the world that does what ours does, and it's well recognized now by the marketplace. So that's a USP. Our other USP is, I believe, we're the only ones in the world that have got a totally integrated, intelligent transport management system. No one else that I know of is thinking of the big picture other than Musk, but you have to buy a Tesla if you want to get into that network. So with our system, it can work on any vehicle. So just to answer that question a bit deeper, our community transport, we're probably the market leader at the moment, but we've only got a very small percentage of the marketplace. So just in Australia alone, there's some 30,000 vehicles, that between 30 and 40. It changes daily, of course, but the government's fully funding that at $200 per vehicle per month at the moment, and in the trial, and we're signing up every day. Like we've signed up 4 new ones this week. So we're signing up new customers every day as the incumbent. The incumbent at the moment wasn't invited into the trial, and they're a US company, and we believe we will be with the chosen one. So a very, very big market opportunity where we're already a market leader and the only ones delivering proper DEX reports to federal government and state governments. So large market growth there for us, in which we are a market leader. We are a market leader, I believe, in our total overall pitch. Our telematics, we're connected into most of the large telematic companies now. So I see some very large growth there. Very, very early days in all of that. And the same with our SaaS platforms. All of them, like we raised $1 million about a year and a half ago to develop all these new SaaS platform apps, and we're just finishing. 2 of them have been launched, and the other 2 come into the marketplace in January, and we see very, very large growth. So very early days still, but massive growth opportunities as we move forward.
And then maybe just one final question. We're just going slightly over time here, but I'll just squeeze it in anyway. The CapEx cost on, putting all the hardware in place for, the smart city stuff. I mean, I get the sense, you guys are investing in that kind of ahead of the curve, and doesn't sound like you're getting a lot of, funding from, city councils, state governments, or whatever it might be. I'm just wondering how you see, the costs involved there with, the potential to like recoup those costs, and, the kind of bigger picture further down the line.
So we don't do anything unless we can make a profit out of it. So we're installing infrastructure. We have to make a profit out of it. If we're connecting into, that's the whole reason we're getting on these major panels, is so we can make sure that we've got government funding for each step of the way. So we're not outlaying. We don't have to outlay huge capex to be able to deliver this program. It's massive. It's a very, very large marketplace, and we're just biting away at it. As each thing comes up, we bite away at it and tender on something that we can make money out of.
Okay, perfect. Geoff, we're going to have to leave it there. Thank you very much for coming back and joining us. And yeah, hopefully we can get you back in some stage in 2025, and best of luck with the with all the trials. And yeah, hopefully we'll have some updates and some good news on those in the next year.
Thanks. Thank you, Mark, and thank you for everyone attending.
And if I could just ask Geoff, please, to stop sharing your screen. And we have Chris McFadden from AF Legal Group standing by. Chris, morning. How are you?
I am well, Mark. How are you?
Very well. Are you going to share your presentation, or do you want me to pull it up for you?
I'm hoping that I can do it. Let's see.
You should have permission. Yeah, it's just loading now, Chris. Yeah, I can see the cover slide of your deck now, Chris. You can take it away whenever you're ready.
Okay, perfect. Good morning, everyone. Thanks for joining us here today. And thanks also for your interest in our company. If you're interested in the slide deck, this one won't be shared, but it's mostly the AGM presentation from 2 weeks ago. All it has is one additional slide, which is a bit of a recap on FY24, which comes from our FY24 results. So hopefully, those of you that have sat through those, you're probably going to see, you've probably seen and heard much of this before. So hopefully I'm consistent with the messages previously. Moving on. Let me try, there we go. Okay, so just a very quick, brief recap on FY24. And then we'll move on to more recent trends. Just there, revenue growth in the year, 15%. And whilst I think average weekly revenue for the year was $417, it finished at $465,000 per week in the final quarter. And obviously assisted by the first full quarter contribution from one of our acquisitions, which we'll get onto. Our normalised net profit before tax attributable to the owners of AF Legal Group for the year of FY24 was $800,000 or near enough. And the important thing there as well was that every half since H1 FY23 has been profitable, and that continued. During the year, we also outlined our growth strategy, and our growth strategy was really to gain scale. That's really what it's about. And there's a slide later that we'll get onto, but it actually saw us announce our move from just being a family law business to moving into complementary areas of law, which we have since done, as we will talk through. And that's the next point. Armstrong Legal Contested Wills and Estates was the first of these. We acquired that in April 24, and it is in our Q4 numbers for FY24 and beyond. And it has started exceptionally well and has exceeded our expectations so far. We've really got a good business there. We've transitioned our organisation into one that is, it's a people-first culture and practice-led, and that sounds fine. And I remember when we talked about it one other time somewhere, people were, well, it sounds nice, but what does that really mean? And I think, or how do you prove it? And I think, we'll see the proof in a minute. So we'll move on to that on the next slide. During the year, we also opened 5 new offices. 4 of those were basically making permanent our presence in markets where we had entered via a shared service setup. And once they're mature enough, we then move into a permanent location and take a lease, because we're sufficiently confident that they're viable businesses for us. Also in FY24, we opened a couple of new markets on this basis, like entering via serviced offices in Frankston in Victoria and Double Bay in New South Wales. Promotions, a few stats there on promotions. So a lot of promotional activity for our teams as we evidence that, our support of them and offering rewarding career pathways for them, which is obviously all important. And the last little point there on that slide is just in relation to the capital raise that we did back in March 24 in relation to the acquisition of Armstrong Contested Wills and Estates. And also at that point in time, we extended our NAB facility. Moving on now to the last quarter. And I think that the detail, I'll just flip through this quickly because the detail is on the following slides. Revenue growth, 13% on the prior year. And that average weekly revenue for quarter 1 FY25 at 483, again a new high. And pleasing to see that it lifted off the Q4 number as well, given that they both included Armstrong Contested Wills and Estates, and we don't have subsequent acquisitions in our Q1 numbers, as we'll get to in a sec. There, and it's a statement that will be repeated later, is that our significant turnaround continues to gain momentum, and I think that's clear in a lot of the stuff that you'll see in this presentation and may have seen previously. But as we say, our normalised net profit before tax attributable to the owners is our measure of profit, and in Q1 that was 362. And when we stack that up against the FY24 number of 781, you can see that momentum is being gained. And that 362 also compares very favourably to both half one FY24 and half two FY24 as well. The other pleasing aspect of the result in Q1 was the operating cash. So operating cash was a strong inflow of $1.5 million, and we'll go into the details on that shortly. But yeah, I think these things eventually unwind, and we saw some of that, but we also see some real positivity around our collection regime and just our business in general. And I think you'll see that in the detail on the cash flow. In October, we then made our second recent acquisition, which again, Armstrong Legal, part of their business, and it was the criminal and family law practices, and also their armstronglegal.com.au website. So we now move into a third area of law, so family law, contested wills and estates, and now into criminal as well. And those results from these areas aren't in Q1, given that it was acquired in October, so they will start to flow into Q2 partially, and then from half two onwards, it should be pretty full steam ahead, I think, for those. Also, just worth pointing out as well that the contested wills and estates business again in Q1 very positive. The next part is, and again, this was all in the AGM presentation. The one thing that wasn't in there is the little stamp that we got yesterday, which is pleasing. So it's all about this Great Place to Work certification. We, as an organisation, when the management changes happened back in July 23, we undertook a survey of our staff just to set a line in the sand and see where we're at. And at 53%, so 53% of the team basically said that AF Legal and its various brands is a good place to work, which is not a great result. But pleasingly, with everything that we've done and working with our leaders, working with our teams, and the changes that we've made to really support our team members, the most recent result, which was delivered in October, gave us a result of 84%. And at 84%, Great Place to Work says you're a great place to work. So that's why we've got the little stamp there. So really, really pleasing for us. I think that this is our, in many ways, this is our greatest achievement so far, and everything that we achieve is built off this, and everything that we will achieve is built off this. So particularly pleased with this and proud of what we've done in that period. Now, this next slide is really just a historic view of things. I won't dwell on any of them in particular because they all sort of pretty much come up on subsequent slides. But the one thing that you will see there is that the trends are positive. You're seeing positive trends there. You're seeing the half-year revenue just continue to grow. You see the average weekly revenue building, in a nice little line there, and you see the blue of the profit relative to the red of the losses before. So a lot of positivity there. Moving on into the revenue, and again, information's there on those presentations if you want to look at it. I won't go into all of the detail here, but again, Q1, $6.3 million, or the best part thereof, gave us a 13% lift on the prior corresponding period, and was also up slightly on the previous quarter, up 4%. And if you look at it there at on the graph 6281, that's 57% of the half two number that's next to it. So you can pretty safely say that it looks like it's heading above FY25. So that trend is really continuing. I think that equally, when you look at the average weekly revenue there, the 483 obviously is another new high for us. But what you see on that line in the average weekly revenue graph is you see that the drops of Q2 and Q3 have been stabilised, and sure, in part that stabilisation has come through the acquisition of Armstrong Contested Wills and Estates, but that was a deliberate strategy for us to gain scale and to stabilise our business. So I think, we can say that is working well for us. When we move on to Q2 in FY25, it may potentially contract a little. And when you look, if you look at the detail of that graph there, the average weekly revenue graph, every time there's a Q2, it actually dips. So there is a bit of a dip as you come into Christmas. Historically, that's happened in the last 3 years. We've also got a couple of gaps in our family law team as we move through the general cycle of people there. And I think, equally, a couple of our best billers as well. One had extended leave, and another one had a pretty serious break of his arm. So little gaps there. But I do think that by and large, a lot of that will be offset by the first 2 months of revenue from the newly acquired businesses. But at this early stage, probably a little bit hard to quantify that. Moving on, and this really, again, I won't go into a lot of detail on this because we'll try and get to questions so I don't run out of time. I'll just be conscious of my time. But and it is covered in a subsequent slide as well. It's a traditional statutory P&L there, which is what it is in a way. It's a useful representation of our business. It shows the $362,000 net profit before tax attributable to the owners, blah blah blah, relative to the 781. So very positive there. I'll skip over the rest of it because a lot of it is on the next slide. And the last little bit down that second box at the bottom, it just sort of repeats the same sort of information at a net profit before tax, before minority interest level. So for those that are interested in it at that level. This is a little bit of a traditional table that we put out with our results on a regular basis, and it tries to consistently sort of show the same things, I guess. It actually, if you look at that there, you see that Q1 profit of 362. If you compare that to FY24, it's 46% of that number. So 46% of our full year profit we've delivered in Q1. So it bodes well for quite a strong FY25. I think it's safe to say that the 781 number is going to be left far behind. How far behind remains to be seen. A lot of other stuff there you can look at there. I think, the Q1 lift in profitability is really driven by our strengthening revenue growth, and that strengthening revenue growth sure is in a large part attributable to the Armstrong Contested Wills and Estates business that we've added on. But what it does show is that our strategy is sound. It actually shows that our as we add on incremental revenue, which we do in the case of Armstrong Contested Wills and Estates, we have a relatively fixed cost base, so more of it drops to the bottom line, and that's what we're starting to see there with some of those numbers. Moving on, now this is a slide that we introduced with our FY24 results, and really it's just trying to illustrate the turnaround in our business since the reasonably significant losses in half one FY23. And you see that ever since then, we've had consistently profitable every half since then. You see that Q1 relative to those other numbers adjacent to it is disproportionate, so it's going to be bigger is the way it's heading. And all of this is on a net profit before tax attributable to the owners of AF Legal. And I know I keep harping on that, but it is important because historically all sorts of numbers were quoted. And the other important part of it as well is that the normalisation is standardised across all of these, because I think if we look back into the H1 FY23 numbers and earlier, the normalisation tended to vary a little bit from quarter to quarter, half to half, and I think that to truly represent our numbers on a consistent basis is really important. So that is definitely apples with apples in this one. Moving on, again, balance sheet. Again, I won't get into all of the detail on the balance sheet because much of it is, insignificant movements in lines that aren't themselves that significant in many cases. You see that our trade receivables are down about $500,000 at a time when our revenue is growing. So that's a very positive thing. There's a lot of comments here under trade receivables, and I would refer you to those. I'll talk through a couple of them. It's all about collections. Our collection process is getting better. I think there was a lot of historic issues in the debtors which have been acted upon. They were acted upon in the H1 FY23 numbers, but where the provisions were taken, but then the actual writing off of those has happened more recently. Just makes it cleaner. It makes our debtors much cleaner, and you don't get lost in the weeds so much. And I think we're seeing the benefits of that. So if we look at calendar 23, 90% of our family law invoices were being collected in about 32 days. So far in calendar 24, that over 90% have been collected in 21 days. So a significant improvement there. In the first quarter again as well, the 90-day plus debtors, $700,000 worth of those were collected, which is the highest ever collection level there on the 90-day stuff, and also a record total quarterly collections of 6.6 million, obviously assisted by 1.5 million of collections from Armstrong contested wills and estates, which is very pleasing. The only other real move of significance there is in relation to deferred consideration. You see in the current liabilities, deferred consideration has gone from 625 to nothing, and really that is the payment of a couple of things. It's the last payment in relation to the Cordos acquisition, so $250,000 for that, and also the first of two payments in relation to the contested wills and estates acquisition, $375. So one of those remains, and you see it down there at the moment in non-current liabilities. Technically, it's probably current, but at a quarterly basis, we don't really rephase those things. Moving on quickly now to the cash flow, and again, very positive for us. A very strong inflow of $1.5 million at a operating cash flow level. Again, I'm not going to go into all the details of that because I just really did, I guess, on the balance sheet slide. But it's all about collections and that improvement in 90 days debtors, but also assisted a little bit by almost $300,000 GST input tax credit, which flowed from the acquisition of Armstrong contested wills and estates. So that payment was made end of April, but flows through into the BAS consequences, I guess, happen in July 24, so into quarter one. The rest of it, outflow from investing activities, a couple of the deferred consideration payments, and also a $200,000 deposit in relation to the most recent acquisition. And the financing activities of $500,000 is really just business as usual stuff. So it's the regular payment of lease liabilities, and it's also some dividend payments to non-controlling interests of around $250,000, predominantly in relation to Withnells, I believe. Moving on, just a couple of slides, and again, I'm not going to dwell on these because hopefully people are relatively familiar with these. The blue on these denotes where something's happened recently, or a current, or it's a highlight issue. And I think the great place to work, we call out there in the people first culture. That's as we say, that's something we're very pleased about. Moving on to new client activity, we have the launch of the film, the Millie film, made by Darren Mort, who is a family law barrister. It's his second film. His first was Tommy, and that was extremely well received within the industry, both locally and overseas. It's actually a training resource in the US, and I think that this Millie movie, the production levels on it are far in advance of Tommy, and I think we expect great things for it. So we are effectively a major sponsor and the executive producer of this. So it will gives us a great asset, if you like, to go out into the market and have conversations with people, which can only be good for our business. The other thing in new client activity is all around our digital lead flow and SEO, and I think that we're increasingly steering ourselves to this. I think Armstrong the armstronglegal.com.au website as well. It's just a cracking website, and the numbers that flow to that are fantastic. So we are really looking to make the most of that, not just for the Armstrong Legal businesses, but for our pre-existing businesses in family law as well, and also the Armstrong Legal family law business, which has now been consolidated or, into our Watts Macrae business locally. A couple of others up there, and I think the only other one there of note is an ongoing issue is around our practice management system. We are currently evaluating, and I think the evaluation is down to the last couple. So we will be launching a project there to replace our practice management system into something that is, should give us great efficiencies going forward and allow us to serve our clients in an even more efficient and effective manner. Last slide is our growth strategy. Again, hopefully you've seen this before. It was released in March 24, and it really breaks our strategy into a couple of areas, into family law and complementary areas of law. Complementary areas of law was a new thing at that point. And it also breaks those down into organic and acquisition. And I think obviously in the complementary areas of law, we've now done the acquisition on a couple of those. So I think that we are really looking to move into an organic stream on some of those. Like, say, for example, the criminal law business is based out of Sydney and only has a Sydney representation at the moment. It was formerly a more national business. So I think our intention is that it becomes more of a national business as well. So I think, you will see, I would hope that you would see in the balance of FY25 that we will open one or two offices in states where we are not in relation to criminal law, and also grow in those states with contested wills and estates as well. So that's all I have. So I'll throw back to you, Mark, in relation to any questions.
Thanks, Chris. We've had a few come in there while you were working through the deck. First one up, we're told the legal profession is one most likely to be disrupted by AI. Can you give your thoughts on risks, opportunities presented by AI across the different parts of the business?
Yeah, and I think it all comes down to that practice management system. Any practice management system, excuse me, that we end up will fully leverage the opportunities from an AI point of view. So we will have a best-in-class practice management system which will allow AI capability for our lawyers and our legal support teams. Whoops, sorry, not sure what happened there. I'll just go back up. Yeah, and I think that we will look for absolute efficiencies there through that. I think that, again, AI is a ever developing area, if you like, and I think particularly in the area of law, and it does some things well, it does some things appallingly, really. So we will use the ones that it does well, and we'll not use the others as well. So I think watch this space, but we should see ourselves within. It's not a quick process in terms of moving into a new practice management system, but I would say over the next 12 months, we will be fully across into something that actually is fully leveraging the AI possibilities for our organisation.
Great. Another one, this is around some of the metrics on the Armstrong Legal acquisition. It was mentioned when Armstrong Legal the acquisition was done, they operated on a more national basis. Annual revenue was in excess of 10 million. What happened for that national presence to decline? What had been the historical challenges it had until AFL acquired it, projecting revenue 3.3 million a year?
Yeah, I think it's no secret that Armstrong Legal was owned by Go to Court lawyers. Go to Court really changed their focus, so they have gone down a consultant lawyer type model through their partnership with Taylor Rose. So they deemed the Armstrong Legal business as not something that they wanted to invest in. So they probably didn't replace and didn't invest in the areas that they were in previously, and they let it basically contract to a New South Wales-based business. Not going to comment on whether that was a good move or not, but I will say that we definitely are looking to restore that. I'm not going to say we're going to get it back to a $10 million business, but I think we'll get it closer. We'll get a long way in advance of where it is currently. So I think in the end, we saw the opportunity in this to grow it and, to buy a quality business with a quality team and to have significant growth opportunities down the track, very shortly, is very exciting for us.
Maybe we could just stay on acquisitions for a second. What should we expect in terms of acquisitions going forward? Is it, refocus back on the family side now that you've put in a few of these ancillary businesses, or looking to expand into new geographies to kind of build out the national presence across family law or across the wills and estates business, because obviously we read about it in the AFR and every business news outlet all the time, the huge wealth transfer that's going to happen with the baby boomers, which is bread and butter of wills and estates, and this huge tailwind is going to flow through that business over the next 10 to 15 to 20 years. So maybe just on those acquisitions, is it more geography based to build out nationally, or is it to add even further strings to the AFL legal group?
Sure. I think never say never, and you don't know what's around the corner on acquisitions. They sometimes just come out of the woodwork, and you take an opportunity when it's there. But I would say that our intention for the short to medium term now is to really bed in the acquisitions that we've just made and to grow those organically, particularly in relation to criminal. So I think you will see criminal into Queensland and Melbourne before too long. I think in terms of contested wills and estates, acquisitions are possible, but I don't think they won't be major acquisitions. They might just be little sweeteners in areas that can generate work for us. And I think similarly back into family law as well, our family law acquisitions would probably be areas where we are not. So if it was I'm not looking at anything in Adelaide, so it's just an example. Don't read anything into it, but we don't have much of a presence in Adelaide. The way to do that, the way to re-enter that market in a decent way would be to acquire a business there. If that opportunity comes up, we may do that, and it may be in other locations as well. Major regional centres as well. But I would think that I think for the next 12 months, I think our acquisition strategy would be pretty modest, really.
And maybe the flip of that then is the question down here on how hard is it to attract either law graduates or young lawyers into the group to try and grow the practices that you have. You can say, okay, well, we want to grow this practice. There's scope to grow this practice here, but you've got the certification now on, it's a great place to work, and that's all a bit of an incentive, but there's way more to it than that to try and pull in the next crop of talent that's going to rise up to be partners in these various businesses.
And I do, in terms of the certification, it's important, but I think already even pre the certification, if you like, from Great Place to Work, the word was already getting out. So I think the word from our own team members spreads. People hear good things. I meet with lots of lawyers, lots of senior lawyers, and the common theme is they're hearing good things about the organisation, which is really positive. So that makes it easier to attract people. We've had a bit of success recently. We have had a special counsel join us in the Gold Coast. We've had a senior associate join us in Perth who's very experienced and could move on to bigger and better things for sure, and see help assist us in expansion into other areas over there as well. And we've also had a very experienced special counsel join us in Canberra as well. So really top quality people. And I think, that is the challenge now. I think we really have to find the individuals who really fit with the culture that we have. I think that, we can't jeopardize that. So I think that, sure, they have to be good lawyers. Sure, they have to, we want them to have plenty of work and the ability to bill and the like. But at the core, they need to fit in with our culture, because we can't disrupt the teams, because that's what we saw previously. And now we've got through all of that. We can't jeopardize that. So I meet with people quite often, and it's a long process. It's not easy to get people to shift, but I have conversations, they're good conversations, and often if it ends up with it's rarely a no, it's usually a not at the moment, so I do keep those relationships alive. And I think that, I do think that it's important that I'm involved in those myself. I'm not as a lawyer, obviously, but I just think to sell the story of AF Legal and where we're heading. And I think that's an important part of what's getting people on board. And you see, again, our numbers, the trends that we've got there, very positive, and people want to be part of something that's going in the right direction. And I think people see that we are. And, I do think that the gaps that we have will be temporary, and, we will have more good people joining us before too long. And I will say the last part is that the quality of the people that we gained through the Armstrong Legal acquisitions, first rate. They are some of the leaders in their areas for sure. And I think to illustrate, I think that we have something like, I did write this down at one point, I can't remember it, but I think, we have 10 accredited specialists in the family law team. On those acquisitions, we have acquired 6 accredited specialists, and also people who are Doyle's accredited. So, the best of the best in many ways. So we are really building, our quality is improving, and the cross interaction of those businesses as well, sees the bar raised everywhere in many ways.
Okay. Chris, thanks very much for joining us and coming back in to give us an update. Hopefully we can get you back in some stage in 2025. And we shall leave it there. So we've gone slightly over time. I don't want to take up any more of your morning. And I'll wish everybody a good rest of their Tuesday, and have a good break over Christmas, New Year. And we'll be back in January at some stage with our next one. This is our last webinar for the year. As I said, it'll be on the YouTube channel tomorrow morning, and then we'll pick things up back in January. Thank you.
Thank you, Mark. Thanks all.